We'll kick it off. Thanks a lot for joining. We have Aaron Christie was with us today. I've met Aaron a couple of months ago. I really like how he approaches business, his mindset and everything. And I want to hand it over to you, Aaron, just for our audience to give them a bit of an idea of what you do, who you are, how you started, a bit of your journey. And then we'll dive into what's really, I guess, important for investors these days. We'll discuss about borrowing capacity, how they can build their portfolio and manage cash flow, all of these details that essentially become even more important now that RBA has increased rates.
Cool. Thanks very much, man. I really appreciate it. And I love the fact that everyone's turning out, and, I want to return. So people giving their time, I want to make sure you guys get the most out of this as well. So if there's questions you want to kind of make sure they get answered, just pop into the chat. I'm sure Maddie will kind of put these together.
Yeah, we'll address them at the end, guys. Honestly, just write down your answers and we'll go through everything. And Aaron enjoys answering questions, so we go through it with a tooth comb.
Yeah, perfect. Yeah, look, from my background, I'm a mortgage broker. I do specialize in helping property investors scale up their portfolios. I typically do work with 1% property investors. So either way, they're aspiring to get to 6+, 10+, for example, with a view that there's two real outcomes that we shoot for. One is either building a portfolio to pay down the primary place of residence and then move into the next phase of investing, or build out the portfolio while they pay down their mortgage and then get to either a net passive or an asset base. So they're happy to come, dial down potentially their day job and then move into more of a lifestyle/retirement phase there as well. And I think when we look at all our investors, the common threads are they're ambitious, they're eager, they don't want to be told no. It's find a way to move forward. We work very, very closely with buyers agents. So I guess we've got this real secret sauce in terms of how we build out portfolios, which, we speak the language of a buyer's agent. We don't call ourselves a finance business. We call ourselves a wealth business. I'm the mortgage broker that makes you money, not saves you money. I think, that's why we talk different, we walk different, we interact different, because we don't really care about the bank or the rate. We're here to grow portfolios, and that's where you get compounding. You don't get a cheap rate to get a better performing asset. You generally get the money to put into an income producing asset that increases in value. And I'll talk a little bit about our philosophy in a little bit, but it's very timely. Like you said, Matt, the fact that we're having a chat today when the RBA is increasing interest rates, the first thing that happens typically for existing people with their mortgages, right, cash flow gets a little bit tighter, and you can't grow broke. And it's something I say fairly consistently as well.
You can't grow broke. Is that what you said?
Correct. You can't.
I love that.
And it's the same for you and I in business, right, Maddie? Like, we can keep throwing more resources at it, but either it becomes diminishing returns, or if you're going to run the business with no profit, you'd ask the question as to why. And so for every investor, when they start to then lose cash flow, or on paper they feel rich, but cash flow wise they feel poor, and asking the question going, man, is this actually bringing us closer to our goal, or is this taking us further away? And so that's why we're trying to build, that sustainability into a portfolio. And again, we'll talk about the how, but I'm just trying to feed you guys the content into what we'll cover as well.
Yeah, perfect. And that's great. So that means when you sit down with investors, you actually plan out before you action. Yeah. So the planning stage is the most crucial aspect of your service, you would say, because it sets everything up for later. Yeah.
Mate, great. We actually implement something that we call a loan strategy. So and you'll see, and that's generally why what we're covering off today is the big three. I'm usually trying to sort out one of three problems for an investor. Do they have a borrowing capacity problem, and how do we address that? Right? Is it an income issue? Is it the way the bank's assessing their income? Are they just in a period of time where had one child, returned to work, and now we need to think about maternity leave? Just one example. Is it an equity play? So do we need to do valuations? And again, I'll show you the secret sauce around valuations, for example, or deposits. Do we split deposits, go and buy two assets as opposed to one? And then the third one, which is cash flow, which I don't really have a lot of control over. I'd say borrowing capacity, a broker. Equity/deposits should become a buyer's agent to buy a growth property. And then the third one, cash flow, is generally your domain. So this is the thing that you're responsible for. So where can you cut costs? Where can you kind of pull the levers in your own household budget that you're optimizing, that you're not kind of bleeding cash? Or if you are, then you look at something like a PAYG withholding variation, for example, or little ways to tweak your cash flow that you're not hemorrhaging as you're growing and scaling.
You provide individuals with some kind of suggestions as well regarding avoiding hemorrhaging as well, because a lot of, me as well, I wouldn't know what the other options are to actually increase my borrowing capacity and increase my savings rate. The nuances, I would say.
No, we try, but ultimately the budget that's everyone's personal responsibility.
Mm,
Yeah, and I think that's probably where some people then look to maybe a financial planner, or they
mm,
go to the granny flat or the commercial to try and increase the yield. They're all really great tactics, but if you're spending more than you earn or you're not saving enough, that's a you problem. That's not a bank problem. That's not a buyer's agent problem. That's a real you issue. So that's where I really want to kind of double down on that and just go, right, how do we have that conversation politely,
mm,
respectfully? And that's why we've pretty much gone, okay, these are the big issues that the big three is what I'm calling it. And
mhm.
it's pretty much our framework that we work with investors. So, mate, you mentioned a little bit of myself. Yeah, look, out of the industry, I put myself in the top 100 fairly consistently as well. And I guess, yeah, that's not again a me thing. That's a whole team. I think that gets me there as well. I'm the front man, but for me, I've got an
I can vouch that you have a large team.
we've got an army. We're a little army. I've only got so many hours in the day, Matt, right? Just like yourself. So I've got to pick my battles. I've got to pick who I work with, the right fit, who gets the best out of us as well. But in order to do that, how I show up and then how the team shows up, but it's a real problem solving attitude. It's a can do attitude. It's find everybody option that you can for someone. And we don't like to be telling people no. So it's here's how you can do it. You may not
Mm,
like the rate, but here's an outcome that we're suggesting for you. And mate, you've had the opportunity to jump on our podcast. It very much is talking to investors. As an investor myself, that's commercial, residential, owner occupied. Of SMSF. I've done it all in that sense. I'm still trying to build my portfolio. I'm always still eager to grow. So that's why I think like attracts like. I'm determined. I'm hungry. I'm not going to stop at any point, whether it's business or investing. I think when you have that mindset about you, which is, man, I'm just never going to sit still. You want people to come on that journey with you. And, that's why I pretty much stopped working with first home buyers. I wrote a book, which is my gift to first home buyers, how to get into the market, how to enjoy the actual fact of having a mortgage. Because I think people with mortgages are the worst billboards for having a loan. They think that life comes to an end and you got to eat 2-minute noodles when you have
mm.
a loan. Absolutely not the case at all. I think you can have your cake and eat it too. And a really good example of having your cake and eating it too is if you want to buy your home and invest, buy your home and then go and buy a property through a self-managed super fund, for example, and you got the best of both worlds. And I don't hear that talked about enough, mate, because I'm like, it doesn't have to be one or the other. It can be that and that as well.
Absolutely. I mean, there are other people's strategy that people choose to rent vest as well. Essentially they rent in an area where they like to live. And I do that,
Correct.
and sort of invest in property. And I love the fact that you said there's always a solution, essentially, is what you're alluding to.
Yeah, mate. And look, with our stuff podcast, you've been on it, mate. I don't have any ambitions to go viral. I don't care about being controversial. We're just providing good information.
It's
And
value, yeah.
I don't want to have like a massive following. There's just enough people that listen to it, that get value off it, that reach out. That's it's quality over quantity. I think that goes for the portfolio even. It's quality over quantity. Nothing like ego numbers in there as well. If I talk through again, one of my big mantras, or when I'm having calls with clients,
Hmm.
I say to everyone, and again, mortgage brokers typically talk about loans. I'm probably the worst mortgage broker in that sense. Going, I don't know rate, I don't know, which color bank we're getting the money from. I just know that you got to keep buying as many as you can.
Mm.
That's the goal. How do you keep buying as many properties as you possibly can? And then we just fit in the right lender and the right rate. And Tom Panos says, you date the rate, you marry the home. I think it's fantastic. I tell clients, you're not buying loans, you're buying homes. And that is almost like this penny drop moment that they go, okay, great. The loan can be chopped and changed at any given point. Yeah, mate, there might be clawback for me after 6-12 months. I've got to redo the loan. That's okay. We play on. But we're not here to kind of just be a loan reseller. We're here to help clients buy a property portfolio that increases in value, that gets them closer to their goal. Right? So
Yeah,
that's
I think that's very relevant, and I had experience with that myself. With us internally building a portfolio and buying, if you're shopping around for rates and that's your primary concern, there are a plethora of other factors that are not maybe suitable for you building a portfolio down the track. So it's like, how do I get the best arrangement? I would say whether it's not all about the rate. Would you say as well? Yeah.
mate. It's never about the rate. It's always about the outcome. So you think about it. If you can take, and we'll talk about this again, but if you can take that deposit, split it across 2 properties, pay your mortgage insurance, cop a higher rate, but now you got 2 assets that are compounding, and then you bought in a growth area that you then go revalue that property in 6 or 12 months' time. the rate has been temporary, but the growth is permanent.
It's
And
cost of business.
correct, correct.
Cost of business. Yeah. No, absolutely. Yeah, that's great.
And so, yeah, if we're trying to have this conversation, then this is the verbatim. This is the type of way we want investors showing up, talking our language as well. And once they cross over and they start becoming clients, they start building portfolios. Mate, you can ask anyone like yourself. The interest rate for your first property, barely anyone remembers. It's irrelevant, but they know how much they bought it for, and they know how much it's now worth.
Exactly. Yeah.
The rate was simply the vehicle, and I've never had a client go and buy a car or not buy a car because the rate was too high on a car loan. They just wanted the car for the functionality, for its utility. It gets you from point A to point B, and it's a status symbol. So it's the same thing that we apply with property in your portfolio.
Right.
Another big one that I speak about is decision fatigue as an investor. And you jump on Htag, and probably one thing that you're guilty of, Matt, is over delivering in spades with the quantity and quality of data that you have at your fingertips. And mate, whatever you call it, analysis paralysis, however you want to put a flavor on it. But I just see decision fatigue with a lot of investors. They're overwhelmed, mate. They listen to one podcast, then they'll listen to someone else on YouTube, then they'll download someone's ebook, and they're just getting in this spiral or this loop that they can't make a decision because there's just so many to make. So I'm just at a point where I'm like, okay, how do we make it effectively binary? So are you going to go P&I or interest only? There's only two repayment types that you can make it. Yeah.
Mm.
Are you shooting for cash flow or are you shooting for capital growth? Yeah. Now you can get somewhere in the middle, but you probably want to have a slant towards one or the other.
Sorry, Aaron, I have to hone in on that.
Yeah.
And I keep on talking about it a lot. One of the questions that people answer regarding their brief creation process at Htag is always asking, are you focusing on capital growth and cash flow?
Mm.
And the usual response is, I want both. And I say, any decision needs to have a hierarchy. You need to have something primary and something edging as secondary. You can't have both simply because of the yield equation in some instances, because it's a seesaw. Yeah. So I think that's actually very important. And because you're trying to stretch yourself in many different directions, this is where the paralysis analysis appears, because you don't have a decision-making hierarchy, i.e. what is the most important thing and how will it get me to my goal as fast as I can?
Mate, spot on.
Yeah.
And the amount of times that you and I will hear someone says, I want this property to wash its face. And I'm like, mate, we're at 95%. We're at 105% fully financed on this property. There's genuinely not very many properties that you find on a net yield that's going to wash its face. So the cash flow conversation becomes redundant. Absolutely. I'm like, if you're at the start of your journey, you want these properties to increase in value. There's your equity. Go and buy again. Like I said, generally most clients, if you're going to be able to go and buy a couple of investment properties, incomes are circa 100, 150 grand. You can't tell me that on that income, you don't have money left over to hold these properties as well. That's why I say you have a cash flow problem, not the property, for example. And so it comes as across sometimes a little bit direct. Others go, man, it's a bit of tough love. But I'm okay with that because that's the only way we're going to get the best out of each other in a broker-client relationship where we can just call a spade a spade. Here's exactly what you need to do to move forward. And we're not sitting around these gray areas just going, but what if it does this? It's like the property should lift in value. That's all it needs to do. Cash flow will come in time. And the cash flows, as of today's decision, just took a beating as well, right? So it just got worse.
Yeah, I mean, I love that. And I think to link it back to paralysis analysis, and I'm a huge believer in shocking people at a certain point in the stage, in the journey. And I had 4 strategy sessions today, 3 with investors, 1 with buyers agents. And when I come to a position where I can see that they're going in a loop, I shock them. I really tell them what the issue is, obviously in a nice way, but that's the only way to dislodge from paralysis analysis. And I think that tough love is necessary. I completely agree.
And we just keep going through. So you said it well. It's a hierarchy. So are we buying a freestanding or not a freestanding, for example, right? So yeah, it might be unit townhouse, for example, because that's affordability. But some people really want a house. Okay, great. Let's just go down that pathway. Same as variable or fixed. It's a repayment type. Is it variable or is it fixed, and why are we doing it? And the next one then comes out asset type. Is it residential or commercial? So you can start to see here, mate. All right, we want to buy a resi. We want to buy a resi house. We want to shoot for cash flow. We want to be interest only, and we want to be variable because we've got an offset account. And so straight away we've taken all these decisions and we've gone bang, bang, bang. Here's exactly what we need to do forward. And now the energy and efforts goes into find the right asset, not the right loan, right? So we're all about asset selection, less about loan selection. Loan simply the vehicle. Let's play on at this point. So I hope that kind of helps for some people that maybe just get in their own way a little bit, or they really get stuck in with spinning wheels, that they go, man, I just can't. It just feels like I got to make all these decisions. Less decisions, keep it simple, rock on. Yeah.
100% agree. Yeah.
Cool. And mate, you've been around the traps for a bit, as have I. Mate, if I look back at any clients that I speak to now, in my broking career, mate, none of them talked about, mate, that was a bad rate you got me into with Pepper 5 years ago. They just go, man, I wish I bought 2 or 3 of these things 5 years ago, 10 years ago.
Yeah, because they look at it hindsight from a growth perspective then. Absolutely, yeah.
Right. And it's always the beauty of hindsight. 5 years ago, they may not have had the ability to go and buy 2 or 3 more. 5 years ago, I wasn't in a position to make some moves that we are today. But it's just more take the lesson out of that going, if you think you're being too conservative now, what will your future self say? And I'm telling people the amount of time I was like, you've got equity, you've got the borrowing capacity. Don't buy 1, make it 2 or 3. And then, I don't know, mate. I'm like, mate, you will kick yourself in 2 or 3 years' time where some of the areas you've pegged will do its heavy lifting, and now you can't get into that particular corridor. You've got to move into a different area as well. So I always say to people, just have a good reality check around, buying more when you have the opportunity to. Be in an acquisition phase if you're in that stage and you're going to go pretty hard for a year or two. Sit back, and then you move into that next phase of growth. And the other one is the amount of times they're being told to sell, right? So maybe the bank or the brokers said, hey, look, you're capped out. You have to sell an asset. They come to us and like, you actually didn't need to sell. If we'd made some more decisions upstream, that's probably where another regret comes in.
Yeah, I want to I really, this resonates with me regarding the sell bit. I'll tell you a story, and I think I said this before in our masterclasses. We bought a property from an investor in an area who didn't see any growth for 4 years and was adamant at selling at a break-even point, essentially, and they sold to us and we did a val 6 weeks later or thereabouts, and property increased by 40 grand. So they sold at the worst possible time, not knowing, and I know you're talking about from optimizing the loan perspective, but also there's another domain here where if they actually held onto the property, they would have made the money, because everything grows through cycles. So, and another thing as well is that I see, as you know, in our mastermind, we do, coaching when it comes to data analysis, and I do a lot of shortlisting for people and stuff, and go through strategy sessions, and we pick the area, and I get a DM from the same individual 6 months later, and they said, Matt, I can't actually buy anymore in this area. And I'm like, why'd you wait for 6 months to actually purchase? Now it's moved by, 10 or 15%. So again, like what you're saying exactly, I see day in and day out in our community. And I think it's actually the cost of indecision is huge.
Yeah. I mean, you think about someone that was in the Perth market for nearly 8-10 years where it did nothing.
Exactly.
They sold out, or they Rockhampton, wherever those areas where that really just shot, and they waited all that time to then sell out. And those investors then came in and it went gangbusters, right?
Exactly.
So someone that was in the market just like hoping that it would go up in value, that didn't go up, they cut it, and then it's like, man, they just got the timing wrong as well. So maybe it's not only selling when they didn't need to, but it's timing entries and exit into markets also.
Absolutely.
Cool, man. So this is I guess the first pillar is what we're speaking about. Ultimately, it's borrowing capacity. So I say to anyone, if a BA put 3 opportunities in front of you today that were all going to be cracker deals, if you couldn't buy it, what's the point? Like, knowing the areas to buy is irrelevant if you can't actually get the money. So we've got to be very clinical and strategic about, okay, being able to pull the next one and the next one and the next one after that, and having someone that's 2 or 3 steps ahead of you, and borrowing capacity is that ultimate lever to pull. So debt to income ratio, look, I'm not going to put much time and energy around it because they talked about rolling this out in Feb. We're at the 3rd of Feb, and there's still very little comms in and around what the APRA changes are. Yeah.
They haven't adjusted, have they? Or
well, the banks have just given us a few indications, but typically I'd say anyone that's like looking to a major bank to grow their portfolio, I'd say they're not the partner for you. Yeah, they're there. Maybe you get a few properties under your belt, but generally at some point you're looking to non-bank lenders, which then brings like the second point into play here. If you haven't heard of a bank, don't worry about it. Like their money, the risk is on them. They're lending their money to you. So if you haven't heard of them, let go of that notion, for example, as well, because I mean, any bank, and you, mate, you know that to jump into, for any bank to get access to the broker channel, they've got to go through hoops, jump through hoops. They've got to do all their balance as well. So they're not just shysters that are coming in. They've got to have a large amount of assets to be able to lend and have resources to be able to, keep up with broker demand as well. So if someone's putting you, in front of a non-bank, or particularly around self-managed super funds and some of these lenders you've never heard of, just don't feel afraid to go with them. Yeah. Because they're lending their money to you. The risk is on them.
And they're doing internally risk mitigation strategies, I would assume.
No, correct. Yeah, great. Yeah,
they don't want to go bust.
Great. And I think as we evolve, particularly as the more astute or professional investor, you've just got to start to go, mate, all I need is the money from a bank. So non-bank lenders do become more investor friendly with the way their living expenses are capped, or the rental income shading, for example, or the treatment around other debts. So again, don't have an attachment to a bank. It's easy for me to say because this is my game, but I'd say if you want to really grow a portfolio, you've just got to be nimble. Yeah. And then just because you've been with a different bank, been with a particular bank, don't think you're entitled to any type of like loyalty. I just like the amount of times we get that from day to day. You've done your banking for 10 years. We're all just numbers at the end of the day. So don't have any attachment around they should be bending over backwards for you because you've been a loyal client. But mate, to me, the big things that I see from a borrowing capacity perspective, one is credit cards. I'll beat this drum for so long. A 10K credit card can reduce your borrowing capacity by nearly 50K. So you could literally, today's RBA rate cut could be irrelevant for you if you just cut up a credit card, because today's RBA rate increase may take off 20 to 30K on average borrowing capacity.
Well, yeah.
You could get that back if you just cut up a 5K credit card. Yeah.
That's a great point. Yeah.
So to me, don't worry about, credit card points. Don't worry about any of this stuff, mate. As soon as you get the loan approved, you can go back, open another credit card. As soon as you get formal approval, you can go get another credit card. But if borrowing capacity is that tight and you need to scrape the barrel a little bit or try and find ways to move the needle, then I'd say the easiest one is a credit card. The second one is a car loan. These car loans just murder borrowing capacity. You've got 900, on average, a $900 per month payment going out. That's what I'm producing. Yeah. So again, it goes back to the very point earlier that we said around cash flow. Hey, Matt, I can't afford the $150, $200 this property is costing me, but that thing's going up in value. The car is going down in value and costing you money month on month. Mate, get rid of the car loan, sell the car, go and buy a cheaper car. And I say this all the time, mate. The only reason I can actually say this is because I've done it. I've actually lost the car loan, got rid of a nice car, bought a cheaper car. I don't have a car repayment per month, for example. I don't do asset finance because I don't click that ticket. If you're serious about investing, these are the moves you have to make to get the results that you want.
Man, that hits home so much. And I'll tell you why for me. I'm in this constant debates and going 12 rounds with cousins, family, neighbors, and everyone under the sun. And I find it ludicrous. And I know there is this, emotional satisfaction for when it comes to rewarding yourself with some goodies, whether it's a car or etc. But I think I rewired my brain, and I rewired my brain especially in the same way that the same things happened to me before. I remember when it came to Australia, I used to get credit cards in the mailbox. That was 25 years ago. And my parents weren't financially literate at that time, and they made so many mistakes, and I've seen them make mistakes and mistakes after again, and a lot of my friends buy these cars, and I drive a Corolla, mate. That's 20K. I paid in cash.
I drive a number 3, dude. It's simple.
Yeah. And you know what? I rewired my brain because I wanted to sort of get educated financially. And the way I make a decision is, don't get me wrong, I love a Porsche. I like a Porsche. It's fine. But it's not the right time. And I buy only what appreciates in value. I rather buy a Rolex than a car.
Yeah.
Do you know what I mean? Because it goes up in value. So I think that's the most important thing. I see a lot of friends. They have a boat, they have a car, they have 2 mortgages, they have this. They're on 300K and they're actually suffocating. They can't. They're going from a paycheck to a paycheck, and I think that's ridiculous. That way, you can't build wealth, in my view.
No, I agree, and it's that whole lifestyle. That the incomes, they call them Henrys, man, high earners, not rich yet, for example. And I see it time and time again. I see people that are on 100K that have a better portfolio than people are sometimes on 350 upwards. Yeah. You don't necessarily need more income. What you need to do is be very smart about where your income's going. And so car loans, car leases, salary sacrificing, for example, for e-vehicles, none of that stuff actually is going to help you. Make some sacrifices. And I think we've labored that point anyway. Cool. So the next one is valuations. I'll come to that in the very next slide in terms of valuations. Lenders mortgage insurance is probably one of the most misunderstood parts of the whole equation. Yes, there are a couple of banks that will do 90% no LMI. One will do it, but it's got to be P&I repayments, and that particular lender doesn't offer negative gearing on that product. So your borrowing capacity actually drops. So it makes no sense to be 90% P&I when there's no negative gearing applied on that servicing, just because you're going to save on LMI, you've got poor borrowing capacity and it's with Ubank if anyone's keen. Whereas you take someone like Pepper Money, 90% no LMI, yes, the rate's with the 7 in front of it, but if you can then be on that rate for, call it 6 or 9 months, you haven't had to outlay the initial LMI, you can then refinance, pull that back to 80-85%, for example, and drop the rate. So that's where we're saying, okay, if you're adamant you don't want LMI, well, then cop a higher rate, but you've got to choose one or the other. It's either pay the LMI, get a slightly better rate, don't pay the LMI, pay a higher rate. You just got to pick your poison. Yeah.
I consider LMI also the cost of business.
Absolutely. Absolutely. Yeah. Stamp duty, LMI, buyer's agent, whatever it's going to be, building and pairs, like we're saying, these are all just costs of doing business. Mate, the next one's pretty much I'd say this is almost like a proprietary bit of IP here. This is something that we've kind of really doubled down on when we're talking about building a portfolio. Let me give the example. You have your home at $1 million and you have the home loan at 500K. So 80% against the $1 million means you can pull equity up to 800,000, which gives you effectively, what are we saying, 300K of equity to strip to go and buy investment properties. Now, if you're a little bit tight on borrowing capacity, what we've found is most brokers will go, yeah, bang, I'll go to 80%, strip the whole 300. But what that's done is that's actually reduced your overall borrowing capacity, because now you're servicing a mortgage of 800 because you can't apply negative gearing on the equity release. So what we've found is, right, you got your equity, you got your loan of 500. Do you have cash that we can do to either debt recycle and pay down the mortgage, or do we strip, say, 150K for the deposit for property 1? Then we come back, strip the rest of the 150K, go for deposit number 2. And that way we can apply the gearing. That's 1, because we don't cross-securitize properties. Applying through trusts as well, it then helps with a trust and a lending strategy there also.
How's the line of credit plays a role there? Is it different? Does it help you if you pull out a line of credit that sits on the sidelines and just invest in property, or with a higher rate?
Yeah, but the thing is, the next bank is going to say, well, hang on, you've got the 500 plus the 300. Now you're servicing an 800K loan. And that's where people are being told, but your next borrowing capacity is dropped.
Yeah. Okay. Yeah.
So instead of pulling the full 300, and mate, this is a small example. Sometimes people got equity of $1 million. So what we're saying is, don't go hell for leather and just pull out a massive line of credit.
Stagger
it. That's exactly it. So you might just go, and it's inconvenient, as a broker, because we've got to do applications every single time, man. But who we're trying to help here, us or the client? So it takes a real attitude shift to go, it's the right thing to do for a client. It's more work for us, but that's why you talk about having a small army here. It's these type of strategies that then go, the investors talking amongst themselves going, man, they said I could get this borrowing capacity. Come someone like us, and we can actually eke out more borrowing capacity just by staggering the investment, the equity strips that we're doing.
Understood.
A lump sum equity strip, and then that shoots you in the foot for the overall borrowing capacity, maybe by the second or third acquisition as well. Yeah,
that makes complete sense. Yeah.
So that's another thing just to think about. Everyone's course dependent. And then what we're talking about here is tax efficiency, whether we're buying through a trust, whether we're buying through personal name, for example, whether we're doing, 99-1 based on who's a higher income earner. These are all just things to think about when we're trying to look over every single bit of detail. That's why if we haven't asked that question and then the next question and the next question after that, we're not getting good quality answers, right? So that's why we'll really push people to go, what do you actually want to achieve? And then we start to go, quite a few layers deeper into what does that actually mean tax? Because everyone's got their role to play, Matty. Like you look at, an accountant will see the portfolio through land tax, through CGT, for example, gearing. A buyer's agent will see that through the, increase in value. I'm looking at borrowing capacity. Financial planners looking at cash flow. So everyone's looking, and so no one's wrong or right, but everyone's just got this different, agenda looking at it. And that's why you just want harmony in the team to say, right, here's actually what I'm trying to go. I'm trying to build a portfolio here by the next 10 years. Can everyone just get on the same page and help me get there? Yeah. The next one I mentioned was around equity strips. So this gives everyone a good example. The same property, different valuation results. Yeah.
Okay, this is interesting. This is very interesting.
And so this is something that we literally did probably a couple of days ago, and they've got more. This is 3. They got a portfolio of 6. I just picked out the top 3. So you can imagine to do, 1, 2, 3, 4, 5, 6, 7, 8 valuations across 6 properties. There's 48 valuations the team has done. But again, it's just what we do, right? So then we can start to look at it going, okay, Crestmead's got a really good valuation with CBA, 146 grand. And then we can start to look across, okay, do we take one property here? Do we take one property here? Talk about strategic equity strips, or do we just go, we keep the juice in the tank for that particular property for later? We pull the 146 out with CBA now. Then we come back later, go to Belmont, strip the equity out later. Then we come back, the equity out later. So we're not just going, bang, let's do all the equity releases. We're going, do we need to just pull that one off the shelf after we've done this acquisition?
It's interesting how they actually do different. Look at the difference in the valuations there.
Oh, it's wild.
And the CBA and Bankwest are always higher than others.
Correct.
Apart from, look at the Crestmead there. It's closer.
Yeah.
But the Belmont one, there's a lot of difference there, which is interesting. I don't know why CBA always values homes higher than everyone else. Have you noticed that?
Mate, everyone, I think both sides, a couple of the guys, even they spoke about it the other day. So this is blown wide open. So I'm not doing, I'm not here flaunting this around, but I think it's become a bit well known that CBA, their computer-based valuations are great. And the beauty for someone like CBA is we can go up to 90% on a computer-based valuation.
Yes.
Most other lenders will trigger it as a full val, which then comes in lower. 90% on a computer-based valuation, rock on. That's so easy. That becomes very easy to do business with, because you're not worried that when you go to submit the deal and it gets escalated to a full val, now it changes the entire equity release component as well. So yeah, that's probably why I'd say their valuation system, on top of being at 90% on using the computer vals, that's a real win.
I know some buyers agents as well that are close. They understand this, and when they're working with mortgage brokers, they purposely go for CBA first, if it's possible, to get that valuation to increase the speed of the portfolio building, and then they sort of diversify thereafter.
Yeah, correct. So what happens is, let's go to CBA for the first deal. We're going at 90% on the purchase, but then we get it revaled on the computer-based val back up to 90%, and you're paying a top-up LMI. And so, again, speed. One's the speed, so it gets revaled pretty quickly as well. You can reval usually every 90 days, 91 days. And then you don't have to chop and change banks. You paid LMI once, you can stay with CBA and you do a partial LMI top-up. So again, the first one might be with CBA, the second one might be with CBA, and then you might run out of borrowing capacity with something like CBA, and then you got to move. Yeah. But they've helped you get in for the first couple, which again, a great example.
Just wanted to ask you one thing, Aaron, and I think I wanted to ask in previous slides, if you don't mind.
Yeah.
Do you have particular stance regarding, and coming from a novice, and there's a bit of ignorance here, so do you have a particular stance when it comes to how many you go with the same lender, or is there a rule there, or do you diversify right away? How does that work?
I don't. I don't have a rule. Usually, to get a limit exposure, you've got to be somewhere between 2 to 4 mil, and some banks will just go, too much exposure. Servicing will usually cap out above before that, but generally a good practice is if you've got trust lending with a particular bank, we keep the trust lending there, and then we move the home loan or we move another investment property in personal name to a
Mm.
different bank. Obviously, I don't explain why. It's just good hygiene that you don't put everything all under one roof as well. But I think, yeah, when we've built our portfolios, it's like, okay, well, we're going here for the trust loans, then we'll go here for the personal home loan, then we can go here for,
Yeah,
the
understood.
negatively geared.
I guess it gives you more power as well.
Correct.
Less power to the bank. Yeah.
Doing it that way, right? Is to create ring fence, or it's to create an ability to scale. That's the policy.
Mm.
The last one here, like I said, strategy. You look at a PAYG, tax withholding variation. That's probably one. I think the self-managed super fund is probably the most crucial part for I see for investors. You don't feel that cash burn like you would out of super. Like if I'm mum, I got a wife, 2 kids, household expenses. If I'm hard pressed and I'm like, I don't want this to cost me too much, well, great. Use your super, keep some cash left over, park it in the offset account, for example, and that's going to help you keep investing and the wheels turning there as well. And then just working it out, going, okay, if you want to scratch the itch around commercial, you can buy commercial sub $1 million. Just understand it's a different asset class, for example. What's the strategy that we're going on that one for as well? Everyone flaunts the whole lease stock. Okay, that's a tool, that's a resource, for example. It's not the way to pin your whole strategy on that.
Can you explain what lease stock is?
So a lease stock loan, typically you got to kick in like maybe a 25 to 30% deposit, which that can come from equity. And then the bank will say, right, you're going to buy a commercial property and it's got 4 years remaining on the lease. So they'll take that current lease that's in place and they'll lend against that current lease and they'll do their numbers based on, does the deal now wash its face based on the current lease and some of the metrics they apply on your borrowing capacity there. But it's not a full servicing check, which is why it's probably slightly easier because they're not applying the detailed servicing calculators in order to get a commercial loan. And that's why it's quite well favored, particularly when you're buying a property that has a strong lease in place, 4, 5, 6 years for it to go. And it's going, mate, that's a pretty solid deal. And there's quite a few banks that are in this space, in the lease stock space. And I think as you see more commercial BAs, as you see the yields in commercial, as you see like the tenant pays for outgoings and guaranteed rental increases, for example, you can see why it becomes more attractive.
Do you see from the clients that you're servicing, do you see any recognizable patterns when it comes to the increase of engaging with the commercial real estate or in response to resi? Or
I think it becomes an evolution here, Matt. So they'll start off with resis, and I'd probably say they get to maybe about 4, 5, 6 resis, and they go, "Oh, mate, I don't want to become landlord of multiple properties. It's it's a good enough number. I've got equity in there now, and I've got the ability to move into commercial, which gets me 7, 8%, which you would never see in a resi. Or in order to do the resi, they've got to build a granny flat on top of it, which some people love, some people don't. Yeah, particularly on which area they've bought in. The commercial then offers off an opportunity to maybe pair an asset in a trust, for example. Kind of then the trust then has an ability to generate cash flow within it. You've got a residential and a commercial in there, and it complements itself quite well because the resi yield, but the commercial is. Yeah. That's another strategy that we see. Or commercial goes into a self-managed super fund. If that person's self-employed, it might be their own site, or it's purely an investment play as well.
Interesting, yeah.
And then the last one is, just that notion of, okay, we're buying, holding, then we're going to be able to hold through cycles like rate increases, like rates flattening out, like, hey, that growth tapers off, for example, as well. And just going, man, like we will go through cycles as well. But yeah, that's kind of what I had so far. But I really want to open up to some questions and some thoughts because that's pretty much where the gold is when we get people.
No, that's great. I mean, so I just wanted to ask you before we open up to questions, like, do you also, when you say you look at potential cycles and the effect of increased interest rates on what the individual buys, to provide them with some context so you can layer the purchases?
Yeah, so say, for example, in the last probably week, as it became pretty imminent that there was a rate cut coming, a lot of the stuff was, hey, man, we either got to get this submitted now, or here's what happens if we wait to submit, and here's a reduction in your borrowing capacity. So we just overlay that strategy because it's ultimately rework, right? Whether that happens now or after a rate cut. And then I think for us, the pre-approval side, it's going, well, fixed rates are moving. So do you go for something like a rate lock and try and guarantee the rate, or do you just go, hey mate, you can't predict the future? And yeah, I think today's rate increase probably taught us that. Like 3 weeks ago at the start of the year, you probably wouldn't have said we're up for a rate increase so early.
Mm.
In the last 1 to 2 weeks, it became almost a certainty. And that's where I think this year, let's take, for example, trust lending. Last year, this time everyone's doing it. Come forward now, it's very exclusively a non-bank space.
Yeah, because of the recent introductions and news.
As an investor, man, you can't just go, I've got this beautiful loan strategy and everything's locked in. It's going, well, the goalposts are going to move. My numbers are going to change. I've got to be adaptable. For example, rates will go, maybe up again. And that's why I talk about a bit of a resilient portfolio. It's going, you got to be able to roll with these punches, because if you don't, and you're going to get, your knickers in, and not every time changes happen, that's where the investors fall off the wagon. And I've seen it for years on end, right? It's one bad tenant, bang, they're like, no, I don't want to invest, I'll go into crypto. It's one bad loan application that went a bit higgledy-piggledy, and it's like, that's it, I'll never, cut my nose to spite my face, I'll never buy again. It's going, man, things will happen, and you just got to be able to deal with it.
Well, mate, if they're going to crypto, they should really expect volatility. I mean, I dabble in crypto myself.
Oh, don't even.
If you have 40% drawdowns, you got to have like a really, really, a good personality, like a stable personality. Otherwise, you'll go insane.
Mate.
And I mean, when it comes to interest rates, the way I see it as well is I rather have the predictability as opposed to trying to time market and see, whether it's going to increase or decrease or etc. You know what I mean? So I rather lock it into for it to be predictable. Anyway, in my view, then as you said, 3 weeks ago, we didn't know there was going to be a rate increase. Who would have guessed that? All right, beautiful. Thanks a lot, Aaron, for that. That's great. Let's open up some questions. So we have LMI, Let Me Invest. Okay, so it says, if you go into the chat, there's only a couple. So for SMSF loans, is there offset facility available? A few brokers I talked to said not available, as you can't pull that money back if you need it. That's from Vickers.
Yeah, you can do. So if you look up, say, Blue Bay, for example, we do a lot with them, that loan does come with an offset account. Yeah. So redraw is probably a little bit controversial, because the whole point is you can't pull the money back out. That's what the SIS Act is there for, the SMSF legislation. But we do a lot of loans that have a fully functional offset account. And so that's typically why we structure loans P&I, put some money in the offset account, and then we're ready to go again. So again, it's splitting deposits. That's another thing that we're looking at when we're talking about building out properties, a portfolio in the SMSF space.
Okay, I didn't know that you can do it, because I heard the same thing as Vickers has pointed out, that it's not available. Yeah. So it comes down to lenders, you would say. This is why you said at the beginning, don't be hooked on the name, I guess. Correct,
man. And even balances. I mean, you probably know years ago, it was like financial planners wouldn't sign off unless you had 250K, balance. Mate, we did one the other day, 120K. Yeah, they bought a cheaper investment property. And I don't judge, and I think it's something that comes up. Mate, if you've done your due diligence and you're the one pulling the trigger on this asset, then you got to live and die by that decision as well. I'll get the loan organized, and I'm not here to judge. So if someone's paying a buyer's agent, my role is to stay in my lane and get the loan organized. I'm not going to go into the lane of going, well, what are you buying? Why are you buying that? That's why you're paying someone else to make that decision, to help you with it as well. But yeah, the SMSF point, you definitely comes with an offset account. You can get in with 120, 150K balance, get you into a resi, and like you said, it might be a stepping stone that you might get into it, exit the market, come out of that, reinvest your cash into a different growth corridor or a different asset.
Yeah, that's perfectly said. Nathan, not a question, but I love what Aaron does. I recently refinanced. I recently refinanced and bought another property through his team, with my last 3 brokers said was not possible. All right, there's some love, Aaron. Let me love heart that. Okay, Scott Agard. Scotty, how are you? What are you both seeing as a typical price people are spending when they switch to commercial further into their investment journey? I wouldn't know how to answer this question. It's not my domain, so I'll switch it over to Aaron.
Cool. Yeah, man, Scott, I mean, you and I are probably very similar. We get the best seat in the house. I get to see everyone's portfolio. I get to see where every buyer's agent's buying. I get to see, how they perform years afterwards as well. Typical purchase price somewhere between 1 to 2 mil. I'd probably say we're seeing that as a real sweet spot for commercial. I think you
Mhm.
get a really strong commercial asset. Um, if it's sub $1 million, it's generally owner occupied. It's a small suite, for example, or it's a storage facility. But anything like those business parks where you got the the garage at the bottom and a mezzanine level, so multi-use, for example, like you could put a gym, a gin distillery, electrical business, a mortgage broking business. You could put any type of business in there and then design the space because it's a bit like an empty small warehouse that has a lot of utility on those type of properties. Yeah.
Yeah, I saw in news that there's a lot of distilleries in
Yeah.
those types of properties.
Business parks, mate, they're good. They're good entry point. And what happens is you got to think about the tenant in there as well, right? So they've got a little bit of room to grow, and it's less retail high street. I don't see any retail high street. The turnover, a business, if they grow, then they're going to outgrow the space, for example.
Mm.
Cafes, the turnover. So then it comes down to not only the type of price point, but then it's the asset selection in commercial that becomes crucial.
That's interesting. Yeah. So 1 to 2 mil is the answer. Yeah.
And I think it's a very doable price point for a lot of people.
So Joseph, low yielding properties which drain your cash flow will stop you from continuing to accelerate properties. I was just a statement. Low yielding properties which drain cash flow will stop you from continuing to accelerate property. Okay, Joe, I'll take this, Aaron, and
Yeah.
maybe you can add to it. Joseph, you have to obviously there is a balance in everything. Capital growth is what allows you to leverage into additional assets. That's a structural rule. Now, unless you have $2 million salary and you can save 150K every month or whatever it is, or my math is probably off, you'll be able to put that deposit and not care about the actual growth aspect of it. But most investors, the way they build a portfolio is through equity, and obviously they need to service the loan. So there could be a bit of a separation between purchase A and purchase B. But in an instance where, first and foremost, the current market doesn't allow for high yielding properties when it comes to residential. You don't have the 7% yields at the moment, which will grow substantially like Perth was 4 years ago. I don't know if it was 7, but it was a little bit less, but thereabouts. You're bound by what the market gives you at certain stages of the cycle in the market. So yes, you can find the balance there, but know that those areas that have continually high yields, they have high yields for a reason. And the high yields are there because the property values didn't increase. And that's why the yield percentage is higher. And when there's a yield compression, the yield compression occurs because you get substantial capital growth on the asset. Now, I do understand that you need to manage the portfolio and all of these other things, which is why portfolio plan and what Aaron was talking about initially is very important. But I see a lot of investors being hooked on yield for all of the wrong reasons. Yield can be manufactured. You can put a higher deposit. You can lower your purchase price. You can lock in the yield at the point of the purchase, which means that you don't need the rents to grow substantially thereafter, and your repayments will drop anyway as time goes by. Each of their own, but I think the concentration on yield, I would personally look for capital growth areas that have a bit of a lower yield and separate the two purchases by, extra couple of years, then actually search for high yield properties, manage 20 properties, create a nightmare there because, as Aaron has pointed out, a lot of his customers come to 5 or 6 and then they don't know what to do, so they switch to commercial because they don't want to manage the whole thing. So I think the notion of yield comes with an asterisk is what I'm trying to say. So let's go. If you extract equity from an existing investment property and use it to buy, if you extract an existing investment property and use it to buy an other investment property, are you limited to a P&I loan, or can you still go in interest only? So if you extract equity from an existing investment property and use it to buy another investment property, are you limited to a P&I loan, or can you still go in interest only?
Definitely interest only. Yeah. So even if you go, most banks will even got to 90% interest only. So yeah, you shouldn't be. I'm always hard pressed to find a reason why someone should be P&I on their investment properties from the get go. Yeah. Now maybe you're in a different phase. You actually want to try and pay down the loans. That's great. But if you're in an acquisition phase, you should always be interest only with an offset account. And if you have, even if you have cash in the offset account, we should always be using equity to go and buy more investment properties. So yeah, that should answer your question there, Morris.
And that's another, coming back to Joseph's observation. If you do that, it helps with yield also.
Correct. Yeah.
So, hey, Aaron, Nav. Hey, Aaron, what's your take on preserving borrowing capacity in individual names? And would you recommend people waiting to build a portfolio go straight into trust structure, especially if they don't yet own a PPOR?
This is probably I reckon my fourth conversation today around, when's it too early to go into a trust? I had one, and it was the conversation with the accountant. The accountant says, no, he's actually encouraging us to go in earlier. And I was like, okay, cool. Because what you'll find is some accountants will actually discourage going to a trust too early. Land tax, for example, no negative gearing benefits. So that's probably why, it becomes slightly controversial depending on your accountant. But yes, I would say before your borrowing capacity is maxed out, you should absolutely be going into a trust if your goal is to scale your portfolio. Yeah. If you're trying to negatively gear, it's not the strategy, for example. But if you want to grow and build a portfolio, a trust also, like you mentioned, their NAV it also helps you keep some juice in the tank if you have ambitions to buy your own home. Because there'd be nothing worse than having a really good portfolio in your individual name that then limits your ability to buy the dream PPOR, which is then where ultimately you have to sell down the portfolio to get into the PPOR as well. Yeah, trusts, I wouldn't say it just comes down to land tax or gearing. It also comes down to what's the strategy for the future in terms of, do you have ambitions to...
Do the losses get credited back in trust after a while as well?
They do. You got to speak to an accountant though, man. I can't.
I think they do. I think I've seen some funds coming into my account.
Yeah.
I've heard lending is easier sub 2 million for commercial. Is this true, and why?
Yeah, because it becomes like 1.5 becomes this imaginary number, or 2 million depending on the bank, for just retail commercial. So over that, it goes to small business banking is what happens. And they go through the deal with much tighter requirements. Sub and 1.5 BOQs, your Suncorps, your ANZs, they've got these policies that are just easy. They'll do commercial pretty much, I won't say tick and flick, but they'll do it fairly easily, sub $2 million.
That's interesting. So, Mitchell, with the recent changes to trust lending with traditional banks, are you able to get lending with non-banks and then refi later down the track to bank lenders? Well, I can tell you that you are, from my perspective, you are able to get lending from non-banks because we're getting it. But then the next side of the question is to you, Aaron, I guess.
Yeah. So you can refi it later. So if you did a dollar for dollar refi, you'd be able to do the simple refi policy, which is they apply a lower assessment rate. Now, what the challenge is typically they don't refi interest only, for example. So that might catch you out where the banks won't have to apply the low assessment rate on interest only loans. You've got to be refining P&I to P&I. So that's one that might trick you up there. But if over time, rates have come down or incomes have gone up, and then you can move it to a major bank, play on at that point. Yes. So the non-bank might get you into the market, then you might be able to move it to a traditional bank. You have to see incomes go up.
Do you see the comments, Aaron?
Yes. Yep.
Yeah, so Alexis, for a negatively geared property in a trust, can lenders treat an equity funded offset reserve as making the trust self-funding for serviceability?
Yes. Yeah. So that's generally a good tip, which is you can put money into the offset account on a trust, go back. So there's two ways you can then address the trust. One is you get an accountant's letter to say that the trust is meeting its obligations, or two, you self-declare. Now, the ability to self-declare is probably tightening up. So I'd say that ship is almost sailing a little bit. There's only one bank at the moment that will let you self-declare, one or two, but they're tightening up their processes anyway. So yeah, what you do is you park money in the offset account, go back to your accountant, find out would they be willing to write the letter that the trust is meeting its obligations, and then see if you can then move on at that point.
Yeah, it's perfect. And I guess, I hope, Alexis, that answers your question. And then Tariq, Given limited serviceability but substantial available equity, would purchasing property through a trust be a practical option? Additionally, are low doc lending options available in this scenario to support further portfolio growth?
Yeah, so what you've got is you've got your equity rich, your borrowing capacity poor is the statement there, Tariq. And yeah, banks don't care about LVRs. Like you might have a 30% LVR, but if you can't borrow more, the bank only cares about serviceability. Would a trust be, even if you're buying through a trust, you'd still have this, you'd still need the servicing. And the challenge that you've got there is with limited servicing, you get no negative gearing benefits on the bank's calculators through a trust. So you got to think very carefully about, that's what was the point earlier, is that when do you actually move into buying through a trust? Because if you leave it too late, you might shoot yourself in the foot there. Okay. Additionally, a low doc lend, yes, low doc would be available. You can only do that if you got an ABN, and for a low doc loan, the ABN's got to be usually active for 2 years. Yeah.
That's interesting. I didn't know that. Yeah.
If you have that intention in mind, speak to your accountant. You might set up an ABN. If you've got a side hustle, if you've got a business, try and build that up, and then you can look at it. But low doc typically caps out at 80% anyway. So if you're trying to strip equity, or you're trying to go in with minimum deposits, you probably can't do that at an 80% lend. You're going to have to tip in a lot of equity on a low doc loan.
Tariq, I hope that answers your question. So now it's Cliff, the last question. Who are the lenders who have some good practices around loan doc construction under a trust?
I'm going to level with you, Cliff. I haven't done a low doc construction. If I'm going to shoot from the hip here, Red Z, I'm going rogue here. My team's going to kill me for this. Rate Money, I reckon, would do it. Your specialist lenders like Bluestone, Red Z, and you can't quote me on any of this because I'm just making it up. But we don't typically do a lot of low doc. I'm going to preface it there. And low doc construction and then a trust, yeah, you might be right here, Cliff. Latrobe might do it, but we very rarely do it because, yeah, generally our clients don't have that. They don't have that need for low doc.
That's great. That's great. We don't have any more questions. I guess this was perfect. I gained a lot from it. Aaron, where can people find you? I mean, I will, guys, post this session, as you know, on the replays, and I'll put Aaron's details. But just if they want to reach out to you, now, essentially, where can they find you? Where do you spend most of your time?
Yeah, look, mate, LinkedIn's probably the best place. Yeah, I'm on there. I'm probably less so on LinkedIn now with all the broker bashing going on and buyer bashing. I don't.
Oh yeah, there's plenty of that.
Yeah, I just don't understand it. But anyway, yeah, check out our website. We usually have a pop-up on our website. People can go in there, usually put their details in, and Siobhan, my assistant, usually manages every inquiries come in. We've got two. Maybe we don't have heaps of brokers. There's two. There's Damien and I, and we're quality over quantity brokers. What we've found is we don't want to stretch ourselves, we're putting new brokers in and then drop the standard. We keep the standard super high. So we say to people, man, we've only got so many hours in the day, but it could be worth the wait rather than getting subpar advice and you've got to go back again to get the answers you want.
Yeah, perfect. So I'll as I said, I'll leave Aaron's details in the post as well. And guys, feel free to reach out. Yeah, his team is very responsive. Siobhan is, I've spoken to her a couple of times. Yeah, she's great. So guys, really thanks a lot for Aaron. First, really appreciate you taking the time and being willing to come and join us. I really got a lot out of this. I mean, I'm in the property space, but I love to learn outside of just data, and I'm a bit of a novice about broking. So thanks a lot for teaching me a few things. We hope to have you again sometime when you have time as well. Hopefully when another rate increases, and then we have to, not hopefully.
That just shows up on rate increases, man. Let's get some rate.
No, we'll try to devise some additional strategies. But again, guys, thanks a lot for everyone for joining. I'll post it on the replays. Aaron, you're a legend.
Thanks,
love your work, man. We'll chat soon, yeah?
All right, fantastic.
All
Thanks.
the best, everyone. Take care.
Yeah.